Imagine you're driving down a busy highway. Some days traffic flows smoothly. You move steadily at one speed. Other days cars stop and go, and you have to adjust constantly. That difference between calm and chaos, that's what the ATR measures, but in the market. The average true range, or ATR, is an indicator that measures volatility, how much price moves on average over a certain period of time. It doesn't tell you direction, not up nor down, but it tells you how strong and active the market is. The concept was introduced by J.L. Wells Walda in the late 1970s, the same engineer who created the RSI and the parabolic SAR. He designed ATR for commodities, which are known for sharp swings, but it works beautifully in Forex, stocks, and crypto too. Let's break it down. The ATR is calculated using something called the true range, which looks at the most recent candle's movement in three possible ways. The first one, the distance from high to low of the current candle. The second, the distance from highs to previous close if there was a gap up. The third one, the distance from previous close to low if there was a gap down. Then the true range is whichever of those three is largest, and the ATR is simply the average of those ranges over a chosen period, usually 14 candles. Here's how to interpret it. A high ATR means large candles, big swings, and volatile market. A low ATR means small candles, tight ranges, and a cold market. Think of it like water. When ATR is high, it's stormy. The market moves fast. Traders are emotional and risk is higher. When ATR is low, it's calm. Price drifts slowly and breaks out might be near. Now, traders don't use ATR to decide when to buy or sell. They use it to decide how much to risk and what to expect. Here are the three main uses of ATR. First one, measuring volatility. ATR shows how much price moves on average. For example, if ATR on EURUSD is 0.0020 or 20 pips, that means the market has been moving about 20 pips per candle, or your chosen time frame. If ATR suddenly spikes to 40 pips, you know volatility doubled, so your trade could move faster, but your risk also just increased. The second, setting a stop loss and take profit levels. ATR is perfect for setting realistic stop losses and targets. If the ATR is 50 pips, a 10 pip stop might be too tight. You will get stopped out by normal price noise. A good rule of thumb, set your stop at 1 to 1.5 times the ATR of your time frame. For example, if ATR equals 50 pips, your stop could be 50 to 70 pips away. That way, you're giving price enough room to breathe. It's like giving a child bigger playground when they have more energy. You adjust the space to match behavior. The third one is detecting potential breakouts. When the ATR rises sharply after a quiet period, it's often the beginning of a big move. The market is waking up. A low ATR means consolidation. A higher ATR equals expansion. Traders watch for these transitions, the moment when calm turns into movement, because that's when opportunities often appear. Now, let's look at a very simple example. Suppose GBPUSD has been quiet, moving only 30 pips per day, and ATR is at 0.0030. Suddenly, after a big news event, ATR jumps to 0.0070. That tells you the market's awakened again. So you widen your stop loss, reduce your lot size, and get ready for faster swings. This is why professional traders love ATRs. It adapts automatically. Whether the market is calm or wild, ATR shows you the rhythm, so you can actually adjust your risk accordingly. Think of it like music. ATR doesn't tell you the lyrics direction, but it tells you the tempo. You trade differently to a calm jazz tune than a fast rock beat. Now, here are some practical tips. On higher time frames like 1 day or 4 hours, ATR helps long-term traders spot changes in market behavior. On lower time frames like 15 minutes or 5 minutes, scalpers use to size traders and set tight but safe stops. Combine ATR with tools like moving average, RSI, or Bollinger Bands to confirm when volatility expansion matches a breakout setup. So let's recap. ATR equals average true range, a measure of volatility, not direction. High ATR, fast market, wide swings. Low ATR, quiet market, narrow ranges. Great for setting adaptive stops, adjusting position size, and spotting new volatility cycles. In simple terms, the ATR helps you trade the market smooth. When it's calm, you can relax and trade smaller moves. When it's volatile, you step back, give traders more room, and manage your risk carefully. So, in short, the ATR is your volatility compass. It won't tell you where the wind is blowing, but it'll tell you how strong it is. And knowing that difference is what keeps you trading boat from capsizing.